Today I've got my special shirt on because we're gonna go into exotic assets, and continuing from last week in looking at the assets that you can invest into in 2022, after the classic ones, the exotic ones. And I will share with you at the end one key asset that you need to invest into, the most important one, so stay tuned. If you have not watched the video last week, do take a look at it to look at the classic assets. As a reminder, today we're going to look at the description of the asset, we're going to look at their historical performance, and we're going to look at where you can actually buy them and why you would want to invest into them. On this picture you have a reminder of the main asset classes and how they performed over the period from 2007 to 2021. You could add art and collectibles to that list. They are very difficult to show as a simple return due to their diversity and also the lack of standard or index. Many pretty colors like exotic fruits, they vary quite a bit every year. You can see that crypto seems to have been a good bet for several years. That's easy to say with hindsight, as crypto used to have a very bad press and was considered a bit of a Ponzi scheme. It still is by some, by the way. The main point is that a lot of those assets have had their moment at the top and they have their moment at the bottom. Things vary every year, and this is just a short snapshot. If you look at a longer period of time, it varies even more. Now we're getting into fun territory, which is crypto and digital assets. The world of crypto is actually quite complex and it's developing really rapidly with the technology. So here you see in this description that you can have payment currencies, you can have blockchain economies, privacy coins, utility coins, security coins, non-fungible tokens, so the NFTs that you hear about, decentralized finance, and also ETFs, exchange traded funds of cryptocurrencies. If you look at the market cap of Bitcoin, then you will see that obviously there's been a very long period of time where it's been very close to zero, and then there was a big peak towards 2017, 2018. It went down for what was called the crypto winter, and then in recent years, since late 2020, 2021, it's really increased quite a lot. And the picture has changed quite a lot if you look at, for example, 2017. Bitcoin was on top with a market capitalization of $229 billion. Then after that you had Ripple and Ethereum, Bitcoin Cash, Cardano, Litecoin, IOTA, Stellar, and Dash. If you look at a few days ago, actually, what you will find for the same top 10 is that Bitcoin is on top, Ethereum, which was third, is now on the second place, but then you have USDT, you have BNB, you have USDC, Sol, Terra Luna, XRP, ADA, and AVAX. All of the rest are basically completely different. So what it tells you basically is that the world of crypto is evolving really rapidly. Bitcoin is actually very well established now. Ethereum is also very well established. All the other coins that you can find out there, and based on the description you have many different types of coins out there, they will move quite a lot in the future, and there are probably about 3,000 of them right now. I wouldn't even look at past the top 100. What would you invest in crypto and digital assets? Well, you can consider that maybe as digital gold. You're convinced that the future of gold is something like Bitcoin. That's more of a moderate risk. You can consider it as a reserve asset. You're convinced that the US dollar will not be the reserve currency of the world forever and that decentralized cryptocurrencies will be. That's quite hard daredevil because it's really difficult to bet against the US dollar at this point in time. You want to benefit from peaks and troughs of the crypto market, so that's medium to daredevil depending on how fast you want to actually be in the market and how much you understand it. You believe in the fundamental ideas of some of the crypto projects because there are many different crypto projects out there. The risk level depends on how much research you have actually done and how much you understand the project and who is leading those projects. You're curious, like risk, but do not want to lose your shirt, so you're ready to invest a little. That's low risk, I would say, as long as you don't put too much of your investment in this. Or you want to become immensely rich with betting on the most obscure crypto assets and hoping that they're gonna explode. That's definitely daredevil, playing at the casino. And how would you access them? You can do some direct purchase with some trading platform like Interactive Brokers or Robinhood. You can have a dedicated crypto purchasing like on FTX, Binance, Coinbase, and there are many more. Dedicated staking platform like Celsius, Nexo. The staking platform give you interest on the placement that you have with your crypto. Purchasing ETFs, which own crypto, there's BTCC, GBTC, Byto, that's evolving really fast right now. Companies which are crypto proxies, if you take MicroStrategy, MSTR for instance, they buy a lot of Bitcoin, so they're a bit of a proxy to Bitcoin. Coinbase, for a company which is actually active on providing the platform for us to actually buy crypto. Now let's look at peer-to-peer lending. That's a very little known area, which is quite interesting actually, because it's, I would say, moderate risk depending on how you're actually investing in it, and it can really provide some good solid constant return. For peer-to-peer lending, we're talking about loans which are performed between individuals instead of a financial institution. They're facilitated by an online platform. You can whether manage your loans with others and pick them, or sometimes the platform will give you a product that does all of that for you. The main risk is linked to the default rate of the portfolio of loans you have, except if the platform gives you a risk-free product. It's with lower returns, and nothing is really risk-free, but that's actually interesting. Check the solidity of the platform you use through the reviews, and even better, checking their financials. Usually the platform only allow you to invest progressively, so it is difficult to put very large amounts of money at first. In this picture you can see some return on investments that are shown for a variety of P2P lending platforms. It's quite an old picture dating back from 2014, but it helps to see the offering in the space and what you can expect. This second picture shows how it looks like for different investors on a platform called Bondora. This helps to understand where you're most likely to end. Most people are in the brackets from 5 to 20% return, which is not bad at all. And that last picture is to remember that there are defaults on loans on those platforms, so particularly if you're picking the loans yourself. So if you decide to build your own portfolio of loans, you should expect that some of those will default, and it's this percentage that you see here, which is basically between 2 and 5% across the years. Reasons for investing in peer-to-peer lending: you want an alternate to the 40% sovereign corporate bonds recommended in the 60-40 portfolio that I was mentioning last week. That's low risk. You have a cash sitting around and want to go in relatively low risk environment to get returns, so that's low risk as long as you pick the lowest risk setting on the platforms. You know the lending market very well, you understand the risk profile of borrowers, and you're ready to take educated bets for high returns. That's medium risk if you know this market very well. You're saving money every month and want to have a better return than what the banks will give you, which is almost zero. That's a fairly reduced risk, I would say low to medium max. For the access, online platforms like Bondora, Prosper, Peerform, Upstart, StreetShares, Mintos, etc. There are many. Many more exist in countries all over the world, so some of them are specialized in the country where you actually live. So do your own research on this. From a personal perspective, I do have money with Bondora for the past few years, so I could see that actually it was risk-free in terms of the platform, because I've had it for many years. Been giving me 6.75% per year on the money that I've put there, which is a Go and Grow portfolio, which is something which is fairly risk-free and has worked quite well for me. And you know what I mean? If you like this video, please do smash the like button and subscribe to the channel. Don't forget to put the notifications on so you actually get the videos notification every week. Art. This might seem to be a place only for wealthy people, but it's a place that actually has become more available to people like you and I, and we can possibly own part of art. So what is art? You have literature, visual arts, graphic arts, plastic arts, decorative arts. You can buy those directly from artists, or you can buy them at auction houses. You can also go through an online platform, so you can own shares of an art piece. On this picture you see an attempt at giving a complete picture of art returns over a long period of time. This needs to be taken with a pinch of salt, as it only represents some auctions and not the entire art market. You can see that if you go with investing in art, in general you are at par with the S&P 500 returns for US stock market. Contemporary art can get you much better returns, though the devil is in the details. Some artists perform much better than others, so you need to know the field very well. Why would you invest in art? You love art, are deeply interested in it, and want to own some for yourself. This is low risk, as it is not about the returns, you just want to have it for yourself. You want to diversify fully your investment portfolio and add a category that is not correlated to most of the other assets. That's medium risk. There are short-term risk with how art is evolving. You're looking for higher than the average stock market return, and you are very knowledgeable about art, so you can make well-educated bets. That's medium risk as long as you know what you're doing. How to access art? Art shops all over the world, obviously. You can buy art very easily through Sotheby's, Christie's, the auctions, and whether you do it physically or online, or a platform called masterwork.io, which own parts of artwork for you, and they do particularly contemporary art. Angel investment and venture capital. Another area which seems to actually only be accessible to wealthy people, but it's something that has changed over the recent years, and now you can actually access companies and startups for angel investment and also venture capital. What do we have here? Angel investment as private equity investing by high net worth individuals for business startups at very early stages of development. Venture capital is private equity investing by institutions, so VC firms, banks, large companies, etc. And that's for business startups at various stages of development. It can be pre-seed, seed, series A, etc. 75 to 90% of startups fail, so this type of investment demands nerves of steel and a very diversified approach on risk. It's basically impossible to give a view of returns on angel investment. It entirely depends on which companies you pick, how many you have in your portfolio, and how each of one will perform. This picture gives you a view of what to expect: a few blockbusters and a vast majority of losers. And on this picture, you see that the percentage chance to get a return with angel investing is when you have a larger portfolio of companies. Why would you invest in that? Well, you want to have a much higher return for your investment portfolio, and you're ready to accept significant risk. That's the daredevil approach. You have plenty of time on your hands, so you understand startups very well, and you love this field, so you want to be in. That's medium risk if you know what you're doing and you actually diversified in the bets that you're making. How to access? Directly with startups that you can come across. That demands having the support to set it up, like contracts, etc. Through venture capital firms, Andreessen Horowitz, Benchmark, Index Ventures, Sequoia, etc., etc. There are many of them, and some of them have segmentation in terms of what they specialize into, in terms of startups that they're investing into, or through angel investment platforms like Angel's Den, Angel List, Seed Invest, Funders Club, etc. Hedge funds and private equity. Right, so that's really about people who have quite a lot of money to invest and they are high net worth individual. Usually the entry ticket is $100,000 for the money that you need to place with some of those companies. What are they? Well, hedge funds are professionally managed private funds that uses pooled money to buy securities or other investments. So that's for high net worth individual, as I mentioned, or institution over 1 million in assets, a salary over $200,000 per year. They are open-ended funds, meaning that money can go in and out over time. Private equity funds are professionally managed private funds that use pool money to buy shares in private companies, not on the stock market. That's for high net worth individuals and institutions with the same definition. They are close-ended funds, meaning that once the target investment amount is reached, the fund is closed and money will be released much later at maturity. That's a matter of years. From a performance standpoint, it's very difficult to find proper information on average return for hedge funds, but this picture gives you an approximation of how it looks like for the industry. As you can see, it does not look fantastic compared to just going for stocks on the S&P 500. However, if you look at these pictures, then you get a very different view, and it very much depends on which hedge fund you have selected. So look at the performance of each one over the years and interrogate what is the fund strategy for the future. For private equity, it's even harder to know what the actual performance is, though this picture gives you what you can expect compared to owning stocks in the S&P 500. Not bad, but again the differences are vast between different private equity providers and funds, which I cannot show as private equity individual fund performance is very hard to come by. Assuming you have the money, why would you want to invest there? Well, you want to be able to invest in companies which you like but are not publicly traded. That's with private equity. That's a medium risk, depending on which fund you access and how much research you have made. You want higher returns across your portfolio, and you have already a high net worth. That's medium risk to daredevil, depending on how you position yourself. How do you access them? Well, you can do that directly with the hedge funds firms like Bridgewater Associates, Man Group, Renaissance Technologies, etc., or directly with the private equity firms, Blackstone, Carlyle Group, KKR, etc., or through investment platforms for hedge funds. Interactive Brokers notably has access to some hedge funds if you have enough capital in your account. What is the best asset to invest into? No, not me, you. The capacity to generate a revenue for yourself is the best protection that you can have with creating savings for the future and increasing your investment portfolio. There are many ways you can consider investing in yourself. A good framework is to consider the different intangible assets that you have. If you look at intangible assets, you have productive, vitality, and transformational assets. Under productive assets, you have your knowledge, your peers, the people that you know, your reputation that you've built over the years. From the vitality perspective, you have your health, being in good health, having a balanced living, which is keeping your energy level high, and also having supporting friendships and family. with you. Transformational assets are about self-knowledge and a diverse networks. That's what helps you to project in the future with a different future. That's it. We've covered the exotic assets this week, and last week we did the classic ones, so we really have a complete picture for how you can build a portfolio with different type of assets, and you've also understood what are the different risk levels, why you would invest in those different assets. Now that you have all this information, it's important that you understand what type of investor you are, the type of risks that you want to take, and the fields that you're interested into. So if you have not done so already, go take a look at these videos that I've made here and here, which explain how to actually discover the type of investors that you are. And keep learning, keep investing in yourself, keep saving so you can actually build that investment portfolio for yourself that will give you freedom in the future. And in the meantime, I will see you in the field, special agents.